We all know that EVs are the vehicles of the future, and that loads of money, and by loads of money, I mean trillions of dollars, will be pouring into the sector. But for an analog just over a century ago, internal combustion engines, these cars were the future. Yet in the US alone, we saw more than 2,000 car companies come and go. Now we've just got a handful. What does this mean for EV investors? Will the winners offset the losers in aggregate? What are your options for investing in EVs in the first place? Joining me to tell you exactly what EV stocks to buy at exactly what time and exactly what quantity. No, I'm kidding. No, there's no certainty like that in the markets, at least legal certainty. But joining me to unpack this in a more realistic way is Anthony Sassine, a CFA charter holder who's head of the Middle East North Africa division of KraneShares and director and senior investment strategist also. And he works closely with KraneShares' EV ETF, KARS is the ticker CARS. It's the KraneShares Electric Vehicles and Future Mobility Index, ETF to be precise. Anthony, thank you very much for joining us today.
Thank you for having me, and thank you for setting such a high bar.
Anthony, I think you're going to clear that bar. I just have a hunch about that. But to give the audience a little bit more of a mental picture of you, I just have to ask, if you don't mind, what kind of car do you drive yourself?
For now, I don't drive an EV, unfortunately, because when I bought my car, it was 2018, 2019. I'm still waiting for that lease to run over. Plus,
Yep.
back in 2018, 2019, James, the EVs were much more expensive than they were today, and the deals you would get were not as attractive. Today, it's a totally different story. If you're going to buy a car today, you will see much better deals on these cars.
They changed a lot. I was in the same boat. I almost got a Tesla a couple of years ago, 2019, early 2020. And I said, I'm going to wait a few more years. I want to do the Tesla, but it's just not quite practical for me because I take these long rural road trips in the mountains like West Virginia and Maine. And it's just, there's not yet the infrastructure, but soon there will be. One more personal question quickly. What is your most unusual hobby?
Unusual hobby is work.
Work. Okay, somehow I figured you would say something like that. I was guess watching sports or work. Got it. Okay, so you live to work. Got it. If your mother or grandmother, someone like that, asks you to explain the logic and the composition of the CARS index, because it's not just like purely EVs, how would you answer besides just saying it's benchmarked to the Bloomberg Electric Vehicle Index?
Look, James, we've worked very hard with Bloomberg and BNF to make it exactly just pure EVs companies, right?
Mm-hmm.
And that's why with the work of BNF, I don't know if you guys are familiar with the Bloomberg New Energy Finance. It's one of the major research firms in the world focusing on new energy finance, on automotive, on transportation. They have over 20 analysts working in that space, looking at every company and making sure they're deriving their revenues from EVs. But you're still going to have some companies, as you mentioned, like especially traditional OEMs who are trying and investing in EVs today, but these companies, James, are capped in CARS ETF at 1%, right? So basically, if you're exactly if you're a company that are working in that direction, you have a lot of investment in that space, but you're not there yet, you'll be included, but you're capped at 1%.
Got it. And the OEMs have everybody thought, Tesla is going to blaze the trail, and just give them a few years, and the OEMs are going to come in and push out Tesla and whoever else is trying to get started first. That hasn't happened. I know I'm getting sidetracked a little bit more into the strategy, but it just seems like the OEMs have just such a legacy burden of software, just the way the supply chain works. Do you think the OEMs are ever going to mount a serious threat to Tesla, to Waylay or NIO, to the incumbents, let's say?
No, exactly, James. I think this year has made it a little bit more apparent that traditional OEMs are behind the pure EVs, right? So that argument was happening over the past 2 years. That some of these major companies have been operating for more than 100 years and are going to come back. But what we're seeing this year, especially in a tough macro environment with price cuts, they haven't been able to keep up. Also, we've learned that they have some design issues, like Ford, right? Like announced on their earnings report that they have 1.7 mile of wiring in the F-150 that they don't know what to do with. Now they restarted the production of the F-150 from scratch. They're pulling out of China, right? We're seeing Volkswagen seek an investment in Xpeng for their platforms. So these guys are going to catch up at some point. Of course, these are big companies, major companies, but not at least in the next 2-3 years. I think it's going to be a more clear runway for the pure EVs, right? And then in the future, we'll see. I think if you want to name one company from traditional OEMs that is a little bit ahead, is Hyundai. I think with their iconic 5 and 6, it's selling really well, and then their Kia brand, but other than that, Ford, GM, they're not there yet. Benz, BMW, they have some nice cars, but it's not only enough to build a nice car. You have to be able to scale. You have to have the contracts for the batteries, for the raw materials. You have to have the space in your factories. Also, you have to have the ability when you go to your boardroom every quarterly to explain your results, not be burdened by the major, the big exposure to ICE, right? 95% of Mercedes-Benz business is ICE, right? So they're going to have to pay
Internal combustion engines, if someone's new to the acronym watching. Yep.
Exactly. So that kind of a little bit of a burden for these companies as they try to transition, from ICE to EVs. And then in the short term, it's going to be hard.
You said it's not only enough for them to make good cars. It's so true. The parallel in investing might be it's not only enough for a company to be a good company in the sense of earnings or market share. You've also got this aspect of investor expectations. In other words, it's reality meets expectations, and the stock price is some reflection of both of those. Now cars, which has about $200 million right now in net assets, is basically exactly matching the S&P year to date, something like up 17% or so, if I'm correct. But over the past 1 year, it's underperformed the S&P by something like 20 percentage points, and maybe like 10 percentage points over the past 5 years. Now, again, cars is based on an index. It's not like you personally managing it. But if someone's watching this, and I'm guessing you're going to say it's a long-term play, which certainly it is. This is a multi-decade trend. But like, getting under the hood, so to speak, what are some of the drivers of the positive performance and the negative performance of cars?
Exactly. So this is a long-term theme, James. That you have 1.2 to 1.3 billion ICE cars on the roads today. We're going to have to switch those to EVs over the next 30 to 40 years. So that transition is happening, right? The government wants you to buy these cars. Consumers are waking up and becoming more environmental friendly. They want to buy these cars. Also, these cars are cool. They're very innovative with regards to technology. So that transition is happening. But we're going to have ups and downs in the meantime. We're going to have some doubts like we had over the past year, right? As rates started to go up rapidly in the US, and China was also getting ready to remove the subsidies that they've had for many years, investors started having doubt about this sector, if it's going to be able to grow, right? And specifically about the startups who are not profitable yet, right? So we always thought that that's not going to be a problem. This is a long-term theme. Investors should be always exposed, even when there is doubt. And now recently we got a confirmation that despite this tough market environment, macro environment, these companies have been very resilient. They cut prices, their sales surged in the second quarter. In June, they're back on track. Rivian has been able to prove to the market that they're able to produce, they're able to execute. That's why they rewarded their stocks. And we saw a lot of investments going into these companies, right? NIO got 700 million from the Abu Dhabi government. Lucid got 3 billion from the Saudi wealth fund. Xbank just got 700 million from Volkswagen, and even Fisker was able to raise 340 million from an institutional investor with an option to double that in the next few years. So we're seeing a lot of interest in that space. We're seeing these companies being resilient, and now the doubt is kind of dissipating, and we're seeing that move in the stock. The move is hard. It can happen quickly. That's why market timing is going to be hard. You got to be exposed to that space. Now, what happened over the past year is, because of the doubt that I just mentioned, electric vehicle companies re-rated lower, right? There was a big down in terms of returns for most of the, especially startups, except for Li Auto, if you're familiar with that space, who kind of became profitable last year. Investors were more confident allocating to that stock, but the rest they were de-risking from these companies. Also, what we've seen happen with Tesla and Twitter and the Elon Musk kind of debacle last year impacted the Tesla stock in a big way. The stock was down close to 40-50%. We've seen that year kind of all these correct slowly, especially starting with Tesla. Li kept going up, and then recently we're getting a confirmation that no, this industry is on track. It's a long-term theme. These companies are going to be able to survive and thrive at least for the next 2-3 years, they won't have any serious competition from the big OEMs. We're seeing investors reward these stocks again.
Yeah, it's been a wild ride. I remember a couple of years ago, I think it was NIO that was literally like a few months away from bankruptcy, and then they got a lifeline, and that saved them, and it really turned things around. So money does make a difference sometimes. Let me go back to a stat that I mentioned, Anthony, at the beginning, which is in the U.S. we've had over 2,000 car companies come and go, and I think in the 1920s, in any given year, we had many hundreds operating. This is when the industry was very new. Just like, let's say, in the late 1990s with e-commerce. I think at one point we had like 900 different e-commerce platforms, and then we have Amazon, mostly just Amazon. Maybe eBay and a few others a little bit now. And I want to say 2017, when kind of the first wave of crypto bubble, or the second wave maybe, we had 40,000 different coins, and I don't know what the number is now. But the point is, there's this boom and then bust with a few survivors remaining tendency for really every new industry. And so you could pick the few winners if you're really, really, really good or really, really lucky. But that seems to be an argument in general for going with a fund, meaning like this thing's going to be hot. I don't know who's going to win. Probably most are going to lose. There are going to be a few winners. Let me just go with a fund. However, that itself is based on the idea that in aggregate, the aggregate like winningness of the winners offsets the aggregate losingness of the losers, if that makes sense. I mean, it's theoretically possible to have an industry that really, looks like it does well, but the losers lose more than the winners win, if I'm being clear. Well, what is your reasoning? And I think in an article, pardon my eyeballs here, I'm just reading some notes, 5 or 6 months ago, you said something like, why take significant individual stock risk when the whole pie is growing? So that again brings us back to that fund argument. If someone were skeptical, if someone were questioning, why can we be so sure that the aggregate winningness is going to outpace the losingness, for lack of better words there? What's your response?
Absolutely, James. This is a great question, and there's few answers here, that kind of to discuss that specific topic. One is only the companies that are established are in the fund today, right? So basically, if you look at how many car companies are in the fund, they're between 8 EVs probably, and then you add to that 5 or 6 traditional OEMs, right? So there are 13 companies. Most of these guys have a high market cap. They're selling hundreds of thousands of cars.
But they're not startups, basically.
So, right. They're not. They call them startups, but they're actually not in a big way. You have a lot of different smaller companies that are also participating, but they're not in the fund. So this is one. And I love this historical context that you brought up back in the days with ICE starting. I have a fun fact there. I don't know if you know that back in the days in 1899 or 1890, EVs were in the lead in terms of being the main technology for cars, right? You had 3 big technologies competing. You had steam, you had EVs, and you had ICE. And EV was in the lead because it was clean and then it didn't have noise. And it was a lot easier for women to start it in the morning. They didn't have to wake up in the morning and crank the thing for the ICE. So really it was in the top. It was, it captured 30-40% of the market. But then Henry Ford came with a Model T and the factory line and changed the whole thing. He was able to sell these cars, ICE cars, for $650 from $1,700, and this is how ICE cars took off for the next 100 years. And in the next 10-15 years, Ford and GM went on to become one of the biggest, most valuable companies in the world, right? So now fast forward 100 years, instead of the Model T, we have Model 3 with Elon Musk, and that's changing everything again. We're going through that new cycle again, right? And then now we're going to have to switch all these 1.3 billion into EVs. So in a historical context, history kind of repeats itself and rhymes, and we're seeing that happen now, but on the flip side of that coin. So basically, you're gonna have you have the first entrants like Tesla, NIO, XPeng, Li, but this thing is, despite all what happened over the past 10-12 years, you really don't know who's going to win that race, James, right? Tesla may be in the lead, BYD may be in the lead, but anything could change. If any of these companies could come up with a solid state battery that can take someone twice the range, guess what's going to happen, right? They're going to go in the lead very quickly. If any of these companies is going to be able to develop their autonomous driving quicker than others and have your car actually take you anywhere without any assistance, or even as Elon aspires to, is to drop you at work and go pick up other people and make money for you, guess what? People, that's going to be a major advantage for that company. So we don't know exactly who's going to win that. Are the traditional OEMs in the next 2-3 years are going to come back in a big way? Is Tesla going to stay in the lead? Is BYD is going to stay in the lead? What's going to happen between China and the US and Europe? There's a lot of uncertainties here. Do you want to bet your chips on one of these companies and take on that risk? You can if you want. You may make a lot of money if you're right, but you may lose a lot if you're not. That's why the best way we think is you get that fund, you invest in that fund, and on the side you have your Teslas or Neos or your preferred companies. Plus, it's not just about Tesla or Neo. The Tesla sources more than 200,000 parts from outside vendors. There's a whole ecosystem that is participating in that space, right? And some of these companies you can't buy in the US, like Cattle, which is the biggest battery makers listed in China, right? So you need the fund to give you access to these companies, and you need the fund to give you access to these whole industries, and also make sure that you're always exposed to the right industries, right? With BNF, we're evaluating that every 3 to 6 months. I don't run the fund personally, but I monitor the fund in a big way. I make sure it includes all the companies, and there's a company that's not included. We go back to BNF, we discuss it. We make sure that the composition is as it should be in the best way possible, right? With constraints on industries and stocks, so not one industry or one stock can take over the fund. It's a really well put together fund, monitored by KraneShares, designed to give people comprehensive, balanced, and pure exposure to EVs. And then if you like some other companies, like I mentioned, you want to take a bigger risk, you can have that on the side, right? And one last thing I mentioned, James, about this fund, it has a very low overlap with S&P 500 and MSCI ACWI. Less than 2% of the companies in that fund or 2% are the aggregate of these companies are less than 2% of the weight of the S&P or ACWI. So when you're adding cars to your global equity portfolio, you're not stacking risk on risk. You're not investing in Nvidia and Apple and Microsoft because they have 0.5% of their revenues, or maybe a little bit more, derived from EVs, but the rest is derived from other stuff, right? So when you're investing in cars, you're investing in a pure EV exposure. There's no US tech there. There's no non-EV stuff in there. It's just pure EVs.
I'm glad you brought that up, and I'm not even saying this as a plug for cars, but it is rarer than most people think to get a pure play fund on something. I mean, things like AI, guess what? Microsoft's doing AI, Google's doing AI, but AI is probably a relatively small percent of most of those companies' revenue, and that's a kind of an open secret that a lot of funds are not really as concentrated as they appear to be to the I guess untrained observer. But it sounds like yours is, and 2% is certainly a small number. And great stat about 30 to 40% of U.S. cars or cars writ large in 1899 being EVs until Henry Ford came along. I guess we can indirectly thank him for cars, but also question him for global warming maybe, but that's a great stat. You mentioned China a couple of times.
Way, back in the days, we solved the big environmental issues, because instead of cars, you had horses in the cities, right? So you had a major environmental issues. And when with the ice, we actually solved that problem, but we didn't know back then that we were setting up for another one. So yeah.
We replaced horse poop with greenhouse effect, basically.
Exactly. It was all over the city. It was just, flies everywhere. Like, I don't want to describe the scene. You can imagine it. But yeah, it was a big issue. It was like there was a huge meeting in New York in 1890, I believe, for most of the cities in the world. They came from Sydney, from UK, from Europe, just to kind of discuss that big problem. So yeah, it was a big issue.
Wow, international conference. Anthony, you mentioned China a couple times, and China is currently the biggest EV market. BYD in English, it just now surpassed Tesla in terms of number of EVs produced, if I'm not mistaken. I've heard some things that some of the Chinese EV makers are just making EVs to go to the graveyard because they're getting some stimulus money for it. So I wouldn't be surprised if there's a little bit of trickery, but in general, it is a huge EV market. So if someone's watching this saying, okay, I got it, China is big, but, I'm a little bit worried, maybe because, for example, Tesla's got, if I'm remembering correctly, got banned from driving in Chengdu when Xi Jinping came to visit because they were worried that maybe, they were going to figure out where he was or something like that, use the data in some kind of nefarious way. And maybe more logistically, a lot of the Chinese EV makers have swappable batteries. Maybe you don't have a charger at your apartment. If you're a typical Chinese city dweller, you got an apartment. So you go to this place and they'll take out another battery and swap you in one. And in the US, which has a lot of suburbs, that model might not work as well. My question to you that I'm leading up to is, what kind of future do you think Chinese cars, which are making inroads into Europe, Chinese EVs, have in the US?
Well, from a pure business economic perspective, they should have a very bright future in the US, right? Because, just like the Japanese cars, these are great cars, very high tech, very advanced technology in terms of, EV and autonomous and everything, and they're very cool. So why not, right? And very, very well priced as well. But here, this is where politics come into play and, throw things out of whack a little bit. We don't know how things are going to happen because Congress is pulling all the stops to keep these cars out of the US, and even keep other producer or supply chain, other parts of the supply chain. Like
27% tax, right? Something like that. It's a big, big, big number.
yeah, but even if they want to set up here, like Cattle was just, announced a deal with Ford to build a huge factory here. Cattle is the number one battery producer, most innovative, highest range, and now Congress is kind of challenging that, right? And I just wonder how we're going to meet those goals in the long term if we don't get the best companies to come and participate. I don't know if you heard about TSMC. 2 weeks ago, they announced that they're going to have to delay the
They
foundry.
couldn't get the people, yeah, qualified people.
Right. So basically, so when you talk about the future of Chinese companies here, from a business perspective and from a technical perspective, it makes a lot of sense. It's the only way now because China is the biggest market. There's the most spending on R&D. They have the biggest, supply chain, raw materials. 70%. They control 70% of the purification of raw materials. It's not just enough to get lithium out of the ground. You just have to take it through a process to make it pure enough to be able to be used in batteries, and they have 70 to 80% of that processes. So they're a big player. They sell 8 million cars a year this year, whereas the US is 1.5, 1.7. So it has to be part of the equation. In Europe, they're much more lenient. They're much more pragmatic. They want to protect their own companies, but at the same time, they don't want to break the bridge with China. So there's more leeway there. Chinese company could have better time in Europe than in the US.
Anthony, would you say that maybe valuation, politics, and then supply chain might be three of the biggest risks in this space? Like, or if there's a different framework, how would you articulate it?
Yeah, no, absolutely. So just keep in mind, James, that this is happening, right? Like you need to keep that in mind. This is happening over the next 20, 30 years. We're gonna have to replace 1.2 billion cars. Now, in the short term, you're gonna have to roll with the waves, right? Like well, you don't know what's gonna happen. No one expected U.S. rates to jump from 25 basis point to close to 5-6%, in a matter than a year. So that's a curveball that many industries had to deal with, including EVs. Although EVs should be in a way more protected from these macro environments, right? Because you're going from a low base, it's a structural growth. You have a lot of incentives from the government, right? So basically, if I have to rate number 1, 2, 3, 4 for the advancement of EVs, one, it's going to be government support, right? 100%. The more government support they're going to have to do, they will have to do more if they want to meet their goals, because currently they're in the insufficient bucket or highly insufficient bucket to meeting their Paris Agreement, which is nowhere near what's actually needed in a net zero scenario.
Yeah, even that's too low. Yeah.
Even that's too low, right? So they're going to have to do more. The 7,500 that they gave, and the other stuff, the 369 billion in the U.S. or Fit for 55. Or the tax package that was just re-announced in China, 72 billion, they're going to have to do more, and that's going to be very essential. 2 is innovation, right? We're not where we need to be first in terms of range and in terms of price, right? So we're looking to hit something called ICE parity. This is when you go to a dealership, you see 2 cars, one in electric vehicle powertrain, the other one in an ICE powertrain, or and then the electric vehicle is going to be cheaper, cooler, and faster, right? Because of the torque and all this kind of things. We're not there yet. We're 20-30% where we need to be. It's going to take a few years to hit. It's not going to be a switch. It's going to start, with the developed countries like China, US, Europe, maybe with some models, and then that's going to trickle down. Probably at the end of that spectrum, you're going to see India, Indonesia, and some of these. But once that happens, this is where real mass adoption, James, is going to happen. This is the inflection point that is going to take whatever we've seen now of impressive growth to a whole new level that, that in terms of sales and adoption. So that's going to be important to hit that. And in order to do that, we need innovation in batteries. Batteries need to be cheaper. We need to find better chemistries to break through that range anxiety. Now the longest battery can do 1,000 kilometers or 600 miles. Consumers would rather have 1,500 or 2,000 just in the meantime now, because they're not chargers everywhere, right? But this could go down or could go higher, but we need more breakthrough innovation in terms of batteries to increase range and lower cost. And then 3, investor sentiment, which is driven by growth in the short term and driven by valuation versus other asset classes, right? Currently, the growth is higher and valuation is very low for EVs. If you compare them with US tech, price to sales now for cars is like 1.2, 1.3. Growth is expected to be 19%. This is all according to FactSet and Bloomberg when you pull this data. You look at the PEG ratio. The PEG ratio is below 0.8. This is when you take how much you're paying for every unit of growth, forward PE divided by next year growth. You look at US tech, they've averaged 2. We're now less than 0.8 for EVs. From a PE perspective, they've averaged 30 to 35. EVs are currently at 18 to 20. So valuation is very compelling and growth is very compelling. It's just investor sentiment is not there yet, and that's going to pick up.
Yeah, tech might be a little bit richly priced with this AI boom, but still, to your point, if those numbers, if we look at just those numbers, and we're not making recommendations here, but it would imply that EVs are pretty reasonably priced right now, at least relative to some of the other, growth stories. Absolutely.
It's the average 30, 33 that I just mentioned, that's a long-term kind of average for Facebook and Google. Amazon's been a lot higher, but definitely AI is helping now. And, that took time. That didn't happen day 1, day 2. It just takes time. It takes building of confidence. Investors want to see proof, and that's going to happen as we see more execution, more cars sold, more adoption, more government support, more innovation from batteries. This will build up, and then I think you're going to see a multiple expansion over the next 2, 3, 4 years.
Sounds great, and hopefully investors in cars and individual EV stocks enjoy some of that, and hopefully it marks a step forward for humanity as well, moving in this direction. Obviously got some major problems with batteries, and we're just not there yet, but at some point, we've been not there yet on many other technologies as a species, and eventually we got there, so hopefully we get there. And I know you, as well as I'm, probably waiting for that ICE parity moment to pounce and become an EV owner myself. Anthony Sassine, Senior Investment Strategist at KraneShares, thank you so much for joining us today, and thanks, as always, to you guys for watching at home.
Thank you.